All right, let's talk about one of the biggest, most confusing money questions out there. This is a decision where getting it wrong could literally cost you tens, maybe even hundreds of thousands of dollars over your lifetime. You know the one I'm talking about. Should you pay off your debt or should you invest? I bet you've stared at your bank account with that exact same thought. You've got some extra cash and you're just stuck. What's the smart move here? Attack that loan or get that money into the market? And hey, it's no wonder we're all so confused, right? Because the advice you hear is all over the place. You've got one camp of experts screaming, pay off every single penny of debt first. Don't even think about investing. And then you've got another group shouting, if you're not investing right now, you are falling behind fast. So what's the real answer? Well, here's the thing. Both of those pieces of advice can be completely wrong. It all depends on your situation. That's why today we're going to break it all down. We'll give you a super simple framework to figure this out so you can stop second guessing and start making the right move for your money. Okay, first up, let's really get into the argument for becoming debt-free. Why are so many people so passionate about this? Well, it all boils down to just how crazy expensive borrowing money really is. Let's start with the biggest villain of them all, credit cards. In the US, the average interest rate is hovering around a jaw-dropping 24%. Just think about that. If you have a $5,000 balance that you let sit for a year, that's $1,200 in interest alone. Poof, gone. Okay, what about something a little more reasonable, like a personal loan? Well, the average rate there is still about 12%. That's a huge drag on your finances. Any investment you make has to earn more than 12% just for you to break even. And now for the number that really blows people's minds. A pretty standard 30-year, $300,000 mortgage, you could easily end up paying over $347,000 just in interest. I'll say that again. You pay more in interest than the entire original price of the house. It's wild. So here is the big takeaway for this side of the argument. When you pay off a credit card that's charging you 24%, you are literally giving yourself a guaranteed, risk-free, tax-free 24% return on your money. Tell me, what investment on planet Earth can promise you that? None. But hold on, that's only half the picture. Because if you just blindly follow that debt-free first rule, you could actually end up with way less money in the long run. So let's flip the coin and look at why waiting to invest can be a colossal mistake. The secret sauce for investors is this incredible thing called compounding. It's actually pretty simple. Your money makes money, and then the money your money made starts making its own money. It's like a snowball rolling downhill, getting bigger and bigger, faster and faster, all by itself. And just look at how that snowball grows. Let's say you invest just $200 a month. After 10 years, you've got around $36,000. Pretty good. But stick with it for 20 years, and that number shoots up to $115,000. And after 30 years, that same $200 a month could be worth around $280,000. And the best part? Most of that is just growth. Your money working for you. This is so important to understand. The biggest weapon you have as an investor isn't how much money you start with. It's how much time you have. Time is the fuel that makes compounding work, and every year you wait to start is a year you can never get back. Okay, so we've got these two huge forces pushing against each other, right? The guaranteed win of paying off debt versus the insane growth potential of investing. So how in the world do you choose? Well, the good news is there's some simple math that can point you in the right direction. It really comes down to this super simple comparison. Step 1, find the interest rate on your debt. Step 2, get a rough estimate of what you could earn investing. On average, the stock market has returned about 8% a year over the long run. Step 3, just put those two numbers side by side. So this gives us a really clear starting point. If your debt's interest rate is way higher than 8%, like that 24% credit card, the math is a slam dunk. Pay off that debt, no question. But what if your debt is at, say, 5%? All of a sudden, the math gets fuzzy, and this is exactly where everyone gets stuck. So let's run a quick scenario. Imagine you've got $10,000 in debt at 5%. With strategy A, you go all in on paying off the debt first. You get it done in a few years, you save about $1,000 in interest, and then you start investing. After about 6.5 years, you'd have around $19,000 in your portfolio. Not bad. But now look at strategy B. You invest right away while just making the minimum payments on that low-interest debt. Yeah, you'll pay more interest in the end, but because your money was in the market longer, it had more time to compound. The final result? a portfolio worth about $20,000. See that? The difference is tiny. The math alone doesn't give us a clear winner here. And that brings us to the most important point of all. This decision is not just about a calculator. Once the math is this close, the real deciding factor is you. It's about your personality, your emotions, and how you handle risk. Because here's the thing, investing is not a smooth ride to the top. The market crashes, and the single biggest risk for most people is seeing those scary headlines, looking at their account balance, and then panic selling everything at the worst possible moment. But if you look at the history of the market, every single major crash has always been followed by a recovery and then new all-time highs. Selling at the bottom is one of the worst financial mistakes you can possibly make. So you have to be brutally honest with yourself before you make this call. How does carrying debt feel to you? Does it literally keep you up at night? And maybe even more crucial, do you have an emergency fund with 3 to 6 months of expenses saved up? Because having that safety net makes you a much calmer, smarter investor. You're not forced to sell your stocks just because your car breaks down. So, after all that, what's the right move for you? We've looked at the numbers. We've looked at the psychology. Now it's time to put those pieces together and build a plan that actually works for you. Here's the bottom line. The best financial plan is the one you can actually stick with. It's always going to be a mix of the cold, hard math and the emotional reality of what lets you sleep peacefully. If having any debt at all just drives you crazy, then paying it off might be the best thing for you, even if the interest rate is low. That peace of mind is worth a lot. At the end of the day, it doesn't matter what some guru on the internet says. It matters what's right for your life and your goals. You now have the framework to compare the numbers and to weigh them against your own personality. So the only question left is, which path are you going to choose to build the future you really want?